South Korea's biggest chip makers just handed out bonuses so massive that the country's central bank is now sounding the inflation alarm. We're talking about payments hitting more than an entire month's salary for some workers, and that sounds fantastic on the surface. Free money, right? Here's the shocker, though. The workers didn't strike, didn't demand a raise, didn't even ask. The companies voluntarily decided to do it. Samsung and SK Hynix both announced these record bonuses, and economists immediately started warning this could trigger a wage-driven inflation spiral across the entire economy. Think of it like dominoes falling. If chip workers get a payday that big, workers in other industries say, why not us too? Wages start climbing everywhere. Suddenly, you've got price inflation that's incredibly hard to stop. The Bank of Korea is watching intently because wage-driven inflation is fundamentally different from other kinds. You can't just raise interest rates and hope it vanishes. There's a deep tension in this story that most tech coverage misses. It's not really about chips or workers or even money. It's about the invisible battle between the supply chain and monetary policy. And here's where it gets interesting. What starts in Seoul could reshape how central banks think about managing inflation globally. To understand why this bonus announcement matters so much, you need to know who Samsung and SK Hynix actually are in the global economy. These aren't just big companies, they are massive. Samsung is one of the top 5 semiconductor manufacturers on the entire planet. SK Hynix is number 3 in memory chip production, controlling about 27% of the global DRAM market. We're talking about companies that make the memory chips inside your laptop, your phone, your tablet, pretty much any device you own that needs to think fast. South Korea doesn't have oil reserves or vast natural resources. What it has is incredible engineering talent and world-class chip manufacturing. The semiconductor industry is literally the backbone of the country's exports and economy. When Samsung and SK Hynix move, the government pays attention. These companies employ hundreds of thousands of workers directly and hundreds of thousands more in supporting industries. They're not just business giants, they are national champions. The work is also genuinely demanding. Chip fabrication plants run 24/7, workers often do 12-hour changes, and the technical skill required is seriously high. For years, South Korea built its competitive advantage on lower labor costs than the United States or Europe. But now there's a problem. They can't keep winning on cheaper wages forever. Talent is scarce, and competition for workers has intensified dramatically. So why are Samsung and SK Hynix suddenly throwing massive bonuses at their workers? The answer has multiple layers. First, there's a war for talent. The whole chip industry is absolutely desperate for skilled engineers and production workers. The United States is pouring billions of dollars into domestic chip manufacturing through the CHIPS Act. Taiwan is investing heavily. Europe wants to build more capacity. That means every major chip company globally is competing hard for the same pool of skilled workers. If you're a brilliant engineer in South Korea, you now have options. Companies will recruit you aggressively. Second, profits have rebounded. After a rough few years, memory chip prices recovered significantly in 2025 and 2026. Samsung and SK Hynix are both seeing stronger margins. When companies are profitable and facing wage pressure, they often decide to share some upside with the workforce before unions force them to. Third, there's a retention problem. The pandemic changed how workers think about loyalty. Younger engineers especially are willing to jump to new companies or even relocate for better pay. Bonuses serve two purposes. They keep current workers happy and motivated, and they send a signal to potential recruits that the company pays well. Fourth, worker expectations have shifted. After years of inflation eating into wages globally, workers in South Korea finally have leverage. Let's talk actual numbers, because context makes this real. Samsung announced bonuses of up to 20 million won per worker. That's roughly $15,000 per person. For SK Hynix, some workers are getting bonuses equivalent to 4 months of base salary. Think about that for a second. A typical South Korean chip manufacturing worker might earn somewhere around $40,000 to $60,000 per year. A 4-month bonus is genuinely life-changing money. It's not just a nice surprise, it's enough to buy a car, put a down payment on a house, or pay off debt. The bonuses targeted skilled workers, especially engineers, senior technicians, people who are genuinely hard to replace. But they weren't limited to just the elite. Even general production line workers saw significant bonuses. And here's what made central bankers nervous. This wasn't a one-time thing. When companies announce bonuses this large in a tight labor market, they're signaling that wages are probably going up next year too. Workers internalize it. They start expecting 20 million won as a baseline. The bonuses got announced in early 2026, and economists immediately started modeling what would happen if this spread to other industries. What if automotive workers demanded similar bonuses? What about construction workers or financial sector employees? One major company's bonus suddenly becomes a benchmark for negotiations across the entire economy. The Bank of Korea ran the numbers and realized if wage growth accelerated beyond 4 to 4.5% annually, they'd have a serious problem. To understand why the Bank of Korea is so concerned, you need context on what's happening elsewhere. In the United States, average wage growth has settled around 3.5 to 4% annually. That's considered moderate and manageable by the Federal Reserve. In Europe, it's similar, somewhere between 3 and 4% in most countries. South Korea's baseline wage growth had been running around 2.5 to 3% before these bonuses. That's why the Bank of Korea worked to keep inflation under control. Wages weren't spiraling. But these Samsung and SK Hynix bonuses changed the baseline entirely. If you're a skilled worker in South Korea making $50,000 yearly and you suddenly get a $15,000 bonus, that's a 30% jump for that year. Even if it's theoretically one time, psychologically you've been repriced. Now compare this to historical patterns. In the 1970s, Japan experienced something similar. Major manufacturers gave huge bonuses and wage bumps during periods of rapid growth. That kicked off a wage price spiral where workers expected consistent raises, companies raised prices to pay for them, inflation climbed, and eventually the central bank had to slam on the brakes with interest rates. The pain from that adjustment lasted years. South Korea watched Japan very carefully because they learned those lessons. They want to avoid that pattern. The central bank is essentially saying, we see a potential Japan 1970s replay starting to form, and we need to get ahead of it before it gets away from us. Here's the core problem central bankers are wrestling with. Wage-driven inflation is nearly impossible to control once it gets momentum. Here's why. When inflation comes from rising oil prices or supply chain disruptions, you can wait it out. The supply eventually normalizes, prices stabilize, done. But wage inflation is different. It's self-reinforcing. Workers see prices rising, demand higher wages to maintain purchasing power. Companies pay those higher wages, which means higher costs, which means they raise prices. Workers see prices rising again, demand even higher wages. You're in a loop. And once workers and companies expect wage inflation, it becomes incredibly sticky. Interest rate increases become less effective because everyone's already locked in wage expectations. The Bank of Korea would normally respond to inflation risk by raising interest rates to cool down borrowing and spending. But that's like taking medicine that has serious side effects. Higher interest rates slow economic growth. They hurt people with variable rate mortgages. They make business investment less attractive. If the central bank raises rates too aggressively, they trigger a recession. If they don't raise rates enough, inflation gets away from them. It's this terrible balancing act. What makes this even trickier? Chip manufacturing is already capital-intensive. Samsung and SK Hynix have billions invested in factories. If rates spike too much, those companies might slow expansion plans. That's a problem for South Korea's long-term chip competitiveness. Let me walk you through how wage inflation actually spreads so you can understand why one bonus announcement worries an entire central bank. Think of the economy as a network of connected industries and supply chains. Samsung and SK Hynix sit at pretty high nodes. They're prestigious employers. When they raise worker compensation dramatically, several things happen immediately. First, skilled workers start leaving other industries to apply at Samsung and SK Hynix. That's normal job mobility. But it creates labor shortages in adjacent industries like materials science, electronics manufacturing, precision engineering. Those industries then need to raise their own wages to stay competitive for talent. Second, workers inside those companies see what Samsung and SK Hynix workers got and think, hey, why shouldn't we get similar treatment? Labor unions use it as a benchmark in negotiations. Before the bonus, a union might have negotiated for a 3% raise. Now they're asking for 5 or 6% because they can point to Samsung's precedent. Third, wage inflation spreads beyond manufacturing to the service economy. If construction workers or retail workers see manufacturing workers getting bigger raises, they organize and demand similar improvements. Fourth, once wage growth accelerates broadly, pricing power changes. Companies see their labor costs rising faster and they start raising prices preemptively. They know their customers' wages are rising, so they can charge more. This is where the loop really locks in. Workers see prices rising, demand more wage increases, companies raise prices again. Here's what this moment means for you. The Bank of Korea is essentially watching for early warning signs of a wage price spiral. They're probably modeling scenarios where average wage growth accelerates from 3% to 4.5% or higher. That sounds small on paper, 1.5 percentage points, but it has massive downstream effects on inflation, currency strength, interest rates, and growth. They've got a few policy levers. They could raise interest rates to cool down wage expectations before they get entrenched. They could signal to major employers that they need to be disciplined about compensation to avoid central bank disapproval. They could support policies that increase labor supply, bringing in skilled foreign workers, for example, to ease wage pressure. Or they could do nothing and let wage growth accelerate, accepting higher inflation as the trade-off. What's most likely? A measured rate increase sooner rather than later. The Bank of Korea won't want to be seen as having missed an inflation signal. For workers, higher wages are great in the moment, but wage-driven inflation can erode purchasing power if prices rise faster than wages do. For the chip industry, tighter labor costs might squeeze margins eventually, but companies that stay disciplined about automation and productivity will be fine. The bigger lesson here applies globally. As supply chains tighten and skilled labor becomes scarcer, wage pressure is returning after decades of worker weakness. That's going to reshape how inflation works and how central banks respond everywhere. What starts in Seoul today might set the template for how economies manage labor costs worldwide tomorrow.